So now we're going to look at the choice of a cost flow assumption. And this is extremely important because when I went through, remember I said we do a physical count at the end of the period. We get a physical count, but the price of those goods that ended up at our physical count, we're not quite sure what they are, right? We make purchases throughout the month, different price points, different amounts of freight, different discounts taken. And so all of those factors are going to influence what items are there at the end of the period. Now, that's where a cost flow assumption comes in, where we say, well, I assume I sold all my oldest purchases first, so it's my most recent purchases that are still in my ending inventory. Or I take the direct opposite approach. I assume I sold all my most recent purchases first, therefore, it's the oldest stuff that's still in my ending inventory, right? So under any method, purchases are going to be the same. The inventory account or the quantity of items is going to be the same, right? 100 items is 100 items. Now, what is the price of each of those 100 items? That's what we're playing with. And so that's going to create a difference in the price of my ending inventory or the value that I want to set for my ending inventory. It'll also affect the cost of goods sold price. So cost methods don't generally relate to the flow, the actual physical flow of goods through a company. For most companies, that will be a first in, first out flow where they sell their oldest purchases first. I mean, that's how grocery stores will place their products. They put the oldest things up front. That's why you see everyone digging in the back for the milk that just came in, the most recently purchased milk. But for the most part, FIFO is that cost flow. However, we don't require the actual assumption to match the physical flow of goods through the company. So there are 4 methods. The first method is a no-brainer. It's called specific identification. It's where we have a small number of unique, costly items that we can directly identify every time we sell. So, for example, if I'm a jeweler, I have a great idea of what every diamond I have in my store is, what every piece of jewelry I have is priced at, and every time I sell one of those pieces, right, I know exactly which one I sold. I can match the cost of that item directly to the sale. I specifically identified it. Pretty rare, like I said, only happens when your sales volume is low. Typically, your prices are going to be a lot higher, and you have some sort of serial number, some sort of a way of uniquely identifying each item that's sold. Now, for more bulk-related transactions, one of the 3 remaining methods is used typically. The average cost method assumes that we have an average cost for all of the items that are in inventory. We can do this at a periodic cost where we just take a weighted average of everything we ordered over the period, or we can do a moving average at any point in time. That would be a perpetual method. Each of these remaining 3 items will have a periodic and a perpetual variety, right? Periodic average cost method, perpetual average cost method, periodic FIFO, perpetual FIFO. So here we just take an average. That is a weighted average, not a simple average. In the next one, we now have first in and first out. First in, first out says that the oldest purchases are the ones that are sold first. Interestingly, under a first in, first out method, perpetual and periodic will always result in the same cost of goods sold and the same ending inventory. You can think of the first in, first out system as a sort of pipeline of goods. When I purchase a good, it enters into the pipeline, and then it just moves along lockstep, where this was the oldest item I purchased, the second oldest, the third oldest, the fourth, the most recent purchase. Now, here's where I have sold the items. And so again, it just goes through this rigid linear way where I'm stocking the shelf, right? This is the oldest milk. This is the next oldest milk. This is the most recent milk. And I'm trying to grab in the back of the freezer for that most recent milk. So that's a FIFO system. Last in, first out is when we think that we have sold our most recent purchases first and that our oldest purchases are the ones that still remain. And the analogy I draw with this one is when I'm feeding my dogs, I just pour all their food into this big bin. And so I fill up the bin, right? So, and that's kind of the same idea as making a bunch of purchases. Filling up the bin, filling up my warehouse, and then I scoop off the top, put it in their dog bowl. Scoop off the top, put it in their dog bowl. It gets down to maybe, an inch of dog food left, and I fill up the bin again. So I never scooped out that last little bit, that last remaining inch of dog food. That would have represented my oldest purchases. And I just keep scooping off the top. And then I might build up another layer, another inch of dog food at the bottom of that bin. And then I fill it up again, right? So I start accumulating all this really stale dog food at the very bottom of the bin if I never scrape it all out, if I just keep filling it up. And that can happen under last in, first out. I'll return to that analogy when we start discussing liquidation of Lifo layers and other consequences of using a Lifo system. Relatedly, last in, first out is the most popular method of inventory costing. So we're looking at a purchase log, and you got to get familiar with purchase logs, how to read them, how to work with them. When you're thinking from a FIFO LIFO standpoint, obviously these are different ends of the spectrum. FIFO, again, would assume that anything up here is sold. FIFO starts by assuming I sold my beginning inventory, and then as it moves down, we assume that these most recent things are in my ending inventory. Whereas LIFO thinks that you sold everything that was most recent, and the things that you began with are actually the things you end up with. Unless, again, like I said in my dog food example, you sell through everything, right? If you don't sell through everything, you're going to have this beginning inventory still left over in the next month, and then in the next month, and so on and so forth, right? So notice now, you've seen LIFO and FIFO before. These are not unfamiliar terms to you. Oh, and I forgot, you got to have a price point here for $10. But these are not new concepts, but what I am going to add into this concept is the idea of working with discounts and returns, as well as working with each of these cost flow methodologies under both a periodic and a perpetual system. So the first thing is, how do you incorporate this additional information, or what's the first step once you have a purchase log? Well, the first step is really determining a few overall things, like how many units did you have overall? How many units did you sell overall? What is the total price of units you had on hand? What are the purchase discounts, purchases, returns, freight, and how does all of that influence the price points? And so the final, or sorry, not the final, I changed this a bit. One of the things I do need to change is that 700 number. There's only 530 units on hand at the end of the period because of the changes that I made in this problem. But now let's look at each of these layers and try to figure out some of that information. So the very first one, 200 units at $7, that we can just take because there's no modifying information. This is what I began with, and so that layer of purchases would be $1,400 in total. Then I purchased some additional. I purchased 1,100, but then notice I returned 15. So I actually would want to reduce my units by that amount, modify the information I'm given, and now I set $8, except there's a 2% discount given on that, and there is freight of 50 cents per unit. So what I'm trying to get when I'm figuring out the value of these layers is all of the variables that affected the price of these units. So I subtract out the 15 units returned. I have a price of $8. I can do the math up here because otherwise I don't want to run out of too much room here. $8. I would multiply that by 98% because I took a discount on those $8. And then I would want to add the freight of 50 cents per unit. And after you do that math, you'll come up with $8.34. So that's actually the price I want to record when I'm figuring out what the value of this inventory layer is, not $8. That amount is $9,048.90. Now, we made a sell on January 10th. Right now, I'm just looking at everything I have in my inventory. I'm not going to worry about the sale right now. We'll look at that again in a bit. I go to my next purchase, 350, but 5 were returned. And then $9, but I had a 1% discount, $9 times 99 cents to get the after discount price plus 50 cents gives me a price per unit of $9.41, which will equal $3,246.45. And then the final purchase, I have 400 units. None of them were returned. $10 per unit, but I add the freight. And then that would give me $4,200. So now I have my inventory in dollar value after considering discounts, after considering returns and all that good stuff. Now, looking at two things. I have units here, right? And then I have my prices here. Or I don't want to say price because that sounds like I'm selling it for that price. Cost. Right? The price of the cost. So I would have had 2,030 units available. And if you add all these guys up, it comes out to $17,895.35. That is the cost of goods that are available, right? And remember that term, right? Remember that term from the inventory equation that we talked about before. We had beginning inventory plus gross purchases. I'm going to lay it out in its entirety. Less purchase discounts less purchase returns plus freight. That gave me goods available for sale, right? So those are those two numbers. Obviously, these guys do not correlate to that. We're going to translate over here what each of these would be. Now, that's goods available for sale, gas. What do I subtract from that? I would subtract whatever I had left on hand at the end of the period, my ending inventory, and that would give me my beginning inventory. All right. So again, this is where an Excel spreadsheet comes mightily in handy to organize all this information. But you don't have that luxury on a test, I understand. You got to get used to doing it by hand for now. Now, I'm going to analyze this equation in two ways. I want to think about it in a units, or physical quantity of units, and then at a cost, a total cost in dollars. That's a C. So in units, I started off with beginning inventory of 200. I made purchases of how much? Let's see, 1,100, 350, 400. Altogether, that's 1,850. I returned 20. The discount, that doesn't have a unit measurement, right? That's a price discount. I did physically return 20 of those units. And again, the freight in is just a cost item. It is not a units item. We're trying to get a physical representation of how many units I had available, and that's where the 2,030 comes from. Remember, if I ended up with 530 by my physical count, which I would make at the end of the year, then that would mean that I sold 1,500, and I just made an egregious mistake here. That is not beginning inventory. That is cost of goods sold. Okay, so now if we're looking at the cost per unit, well, I already have some of that information laid out, right? My beginning inventory was $1,400. That was the 2 times the $7 per. Then my purchases, my gross purchases. Now this would be the number before discounts, before purchase returns, before freight in. Well, then I'm just going to take 1,100 times 8, 8,800. 350 times 9, which is 3,150, and 400 times 10, which is 4,000. Add those up. Those are my gross purchases. They are 15,950. That represents my gross purchases. Now the purchase discounts came in, and you would analyze that by taking 2% of $8. 2% of $8 would give you 16 cents per unit. And since we don't include the units returned, you multiply that by 1,100 minus 15, 1,085. Then you would add a 1% discount on 340 units. I'm sorry, 345 units. That would be 0.09. Those would give you two discount amounts that will add up to your total discounts. So your total discounts in this case, let me make sure. In this case, your total purchase discounts will come up to, let me do my calculation. $1,085 times 16 cents per unit plus, so that's $173.60, and 345 times 0.09 is 3105. So that will come up to $204.65. The purchase returns, 20 of those items. Now, 15 of those units that we returned were at $8, and 5 of them were at $9. That's going to be $165 of purchase returns overall. The freight in is going to be everything we purchased, the number of units we purchased this time, which is 1,850, times the 50%, the 50 cent per unit return freight. Well, then that comes out to $9.25, except that we returned 20 And so that actually nets off $10. And then now we add those together, and we can see that it comes out to $17,895.35. Your ending inventory now is a question mark. Your cost of goods sold is a question mark. Why are those question marks? Because I know how many units I have left over. The question becomes, at what value do I want to record those units? Do I want to assume that it's my most recent purchases that are in my ending inventory? Do I want to assume that it's my oldest purchases that are in my ending inventory? Or do I just want to assume an average price point and just assume that everything in my ending inventory is an average price of all the goods I had during the period? So we're going to look at all those methods. Now, do you have to go through and calculate all this stuff? As you saw, it was kind of rigorous. No, you don't have to do it. It does give you some nice intuition about what's going on behind these price points. Notice that I just combined all of that purchase discount, purchase return, freight in information when I was calculating the prices and the units that I wanted to multiply by those prices, but I got the very same numbers, right? I just want to show you exactly where these items are coming from, so that you see how all of this stuff is connected. Now, it does help a bit because whenever you make a journal entry to record the closing of inventory under a periodic method, you got to know purchase discounts, you got to know purchase returns, you got to know freight in, you got to know your gross purchases. That's not necessary under a perpetual method, but under the periodic method, it is necessary. Okay. I am also going to take this information that I have now calculated and use it to expedite the discussion of calculating the cost of goods sold under each of the methods that we now turn to. So, for example, here we have the weighted average periodic method is the first cost flow method I'm going to look at. Now, remember, what I said about the weighted average method was I want to get an average price point per unit. Because I'm using a periodic method, I want to consider all of the information at once. That is, all of my purchases over the period and all the units I had available during that period. So to get an average price point that is a weighted average, I would take $17,895.35. That's my total value. Divide it by the goods I had available for sale. That's the unit. And that gives me that price per unit. So that gives me $8.82 per unit. Now, how much did I end up with in my ending inventory? Right? Now I can price my ending inventory. I can figure out, right, 530 times this amount gives me that first unknown. So 882 multiplied by 530 gives me an ending inventory of $4,674.60. And remember, that's my ending units. That then becomes the cost of my ending units because I supplied an assumption. I assumed that they're at a weighted average cost of this much per unit. Well, that gives me my ending inventory value. Now, because of this beautiful equation here, we have gaps. Once I know my ending inventory, I can subtract ending inventory to get cost of goods sold, right? Or I could take 1,500 units that were sold, multiply it by that same price point, I'll get the same answer. But just doing that simple arithmetic, I had all of this amount available. If I ended up with that amount, then I must have sold the difference between the two. The difference between the two here amounts to $13,220.75. That would be my cost of goods sold. How do I represent this in a journal entry? Now remember, I've already figured out my cost of goods sold, but I would need to journalize this appropriately under a periodic method. Under the periodic method, remember, I do need all of these balances. I need all of that information. So the very first thing I do is I get rid of everything that is in my inventory account. So I credit my inventory by the beginning inventory balance, $1,400. I would also need to credit any accounts that increase the inventory account because I need to close out my purchases and my freight in. So close out purchases. Purchases were $15,950. What else do I need to close out? Well, I need to close out freight in. Freight in, after I considered that I had some returns, came out to $915. Now, what else do I need to do? I need to create, because remember, I totally credited my beginning inventory balance. Now I need to establish with a debit my ending inventory balance, $4,674.60. What else do I need to debit? I need to debit all those other nominal accounts that have credit balances, the purchases account, I'm sorry, the purchase discount, the purchase return account. So to get rid of that purchase discount account, I need to debit it for $204.65. The purchase return is at a $165 balance, so I debit that. And then finally, cost of goods sold is my plug. Again, this is just another way of working through that arithmetic equation. The cost of goods sold, you see, I'm just going to put that number down there, but you can plug and find out $13,220.75 is going to be your plug, your unknown for this problem. And so ending inventory was $4,674.60, and the cost of goods sold was $13,220.75. All right. So a lot of setup, but all that setup really helps solve this pretty quickly. Now, looking at this under a perpetual method is distinct from the periodic method, because under a perpetual method now, what I want to do is calculate a cost of goods sold every time I sell something. Remember, it's continuously updated. So rather than consider the entire period, I go to the first sell point, and then I determine a cost of goods sold. So I want to consider, remember, my first sell now was January 10th, 2016. So I'm only going to calculate an average price point for these first two layers. The first two layers, if you recall, one was 200 times 7 was as written up there because there was no modifications we had to make to it. And then we purchased 1,100 units, but remember, we returned some of those units, 15 of them, and the price point after considering the discounts and the freight was $834, and that layer was $9,048.90. So now those were the only two layers, and then I had a sale. So I stop and I calculate the average price of those two items, of those two layers together. So again, I get the total amount, the dollar value of those two, and add them together. That gives me $10,448.90. I then divide it by the amount of units that represents, 1,285 units. And that gives me a price of those two layers, average price of $813. I sold 1,000 units. And so that gives me $8,130. That would be what I would write as my adjustment on that sale for cost of goods sold and for inventory. So don't have to keep track of all those discounts because all that information is already bedded in here. Just credit it straight to inventory. Now, after I have that, this is where people will mess up a lot on the perpetual method. Don't let it be you. I have now calculated an average price for 1,285 units. I still have, because I only sold 1,000, 285 remaining at this price. So that becomes the starting point for my next average, 285 at 813, and then I move to the next purchase. I said I purchased 350 at 9, got a discount, returned some, so it really was 345 after the returns, after the discount and the freight, it came out to 941. And then I have another purchase of 400. None of them were returned. Only thing I have to add is freight to the price. And then I just figure out what each of those would have been. So I have 2,317.05 of what wasn't sold from that first average. Then I have 3,246.45. Now remember, this was information you've already determined here. That's why I'm just ripping it out, because you have that. And then the final layer was 4,200. So again, total up these layers to get the numerator, the total cost of what you got. That is not correct, sorry. That would be 9,763.50, and divided by the total units you have, 285 plus 345 plus 400, 1,030. And so the average price per unit, considering those, would be 947, or actually 48 if we round, and always round to the nearest penny. Now, that's the price. We sold 500. That comes out to 4,740. And again, we make a cost of goods sold entry, an inventory entry of that amount on that date. Because under a perpetual method, we are perpetually updating, right? Now add those two COGS together to get the total amount of COGS for the month. That would be 12,870 is my total COGS. And again, I'm always going to have the same goods available for sale, 17,895.35. And so either way, if I have gas, I subtract COGS, I get ending inventory. If I have gas, I subtract ending inventory, I get COGS. So in this case, I'm deriving my ending inventory, and it will be 5,025.35 as my ending inventory. Right. So that is the weighted average method. And that is the periodic entry I would make to record COGS under an average weighted average method. Notice the calculation changes as well as the entry changes. And then under a perpetual method, the calculation changes, the entry becomes noticeably simpler, right? Now we're going to look at the same stuff under FIFO. And the calculation becomes even easier under either method. So FIFO, periodic, the first thing I determine when I'm doing FIFO or Lifo is how much I sold. I kind of reverse the final step of that inventory equation by just saying, all right, well, what did I sell, subtracted from my goods available for sale to derive my ending inventory. You can go at it either way, it will give you the same number. I just find the sale a little bit easier to deal with sometimes. You could start with, oh, well, I had 530 units left. Which ones do I assume I have left? So with FIFO, I assume I have 1,500 units sold. Under FIFO, I assume I sold my oldest purchases first. So which ones here are my oldest purchases? Then that would represent these guys first, then that next purchase, and then that purchase. So I want to keep going down the list like that. So of these 200, I sold all 200. Of the, remember, 1,085, I sold all of those as well. And that was at the $834 price point. Now I need how many more? So 1,500 sold. I've already accounted for 1,285. I need another 215. Well, that's all going to come from this layer. I don't completely use up that layer, but that's where it comes from. That's, again, the same price point as before. Do the multiplication to figure out what each one is worth. 1,400. The whole layer is 9,048.90. And this one is 2,023.15. Total them up. This is your cost of goods sold. And again, if I have my gaffs, 12,472.05 as my cost of goods sold. If I'm subtracting that from my gaffs, I'm getting my ending inventory value. You could come up with that ending inventory by just working backwards, by saying, all right, well, if I'm working under FIFO, as I said before, if I'm working under FIFO, I'm assuming I sold my oldest stuff, so that means I'm keeping my newest stuff. 400 units at 10 would have been kept. So 530 units left over. Well, then it must have been the 400 there. And 130 of those. Do the math on that 130 real quick. 130 times 941 is 1,223.30, which gives me the same ending inventory. Right. So either way you want to approach it, I will say that calculating what's sold to me is easier when you're using the perpetual stuff. The periodic, either way, is really easy. Perpetual, it's easier to figure out, well, I sold this, I sold that, what's left over? Okay. Well, let's look. Under a perpetual method for FIFO, now, I told you, and it's true, COGS and ending inventory are going to be the same, perpetual or periodic, but I want to show you how the perpetual works. 200 units began with, 1,100 purchased, then I sold. I stopped there. Now, 1,000 units were sold. I start at my oldest purchases first, 200 at $7. Then I pull the next 800 from this layer. 800 times 834. I have to develop a cost of goods sold, remember, every time I make a sale, so that's why I make that stop. I don't go to the end of the period because then it's no longer a periodic method. Then that would be my COGS at 110.16. I would make the entry, debit cost of goods sold, credit inventory, and then I would look at the rest of it. I'd say, okay, purchase, oop, now I sold. Now, when I sold under FIFO, I go back to the oldest things. Those are all gone. That 200's gone. Now, there is still some left here. How many are left there? Well, remember, there were 1,085. I used 800, and so now there's 285 remaining at that 834 price point. And to get up to 500, then I have to sell off another 215, and that would be at the next price point, which was 941. So that comes out to 2,502. That comes out to 1,882. So then, oops, that might be a little off actually. Nope, sorry, wrong numbers. 285 times 834 is 2,376.90. 215 times 941 is 2,023.15. Add those together. That comes out to 4,405 cents apparently. So that would be the COGS I would record on January 30th, 2016. To get total COGS, of course, then I want to add the two together. Which matches the cost of goods sold I found up here, right? So they are equal. And again, to find the Indian inventory, just take gas, subtract COGS, you get Indian inventory, because we know that equation helps us every time. Lifo, basically the same procedure as FIFO, just put totally in reverse. Now remember, I sold I sold 1,500. And so what Lifo tells me is that I sold my most recent purchases. So I still have 1,500 units sold, but I start at my most recent purchases. My most recent purchase was 400 at 10. Remember, it's 1050 because of that freight. Then I sold all of that layer. Remember, it's only 345 because of the returns. And then I would need, let's see, we had 745, so that means I still need 755. Those would be taken from that layer because it's the next most recent purchase, 834 per unit. Figure out what the total of each of these layers would have been. And then add them together to get the cost of goods that are sold. And again, now that you have the cost of goods sold, subtract it from goods available for sale. That would be my ending inventory. Under a perpetual method, again, we want to stop at every sale and then calculate COGS. So on this purchase log, I'd start at January 10th as my first sale, right? I sold 1,000 units. I'd sold 1,000 of those units at $834. That gives me $8,340. That's my COGS on that date. Then I sold 500 units. Well, I would sell 500 of those first. All 400 of those would go at $10.50 per. And then I would sell 100 of those guys there. Remember, it was at a $9.41 price point. And combine those two to figure out what COGS would be on that January 30th date. And then combine both of those together to figure out what my total COGS for the month would be, and then I can subtract it from my total goods available for sale for the month to get how much ending inventory I still have remaining on the books. Okay. So those are the cost flow methods. Make sure that you understand them. Make sure you can calculate them. Make sure you can do the entries, the inventory entries associated with periodic and perpetual. Make sure you know how to do it. All right. Now I'm going to talk just a bit about conceptually what are the advantages and disadvantages of using FIFO versus Lifo. Now, as you might have noticed, right, under Lifo and FIFO, we have some sort of diametric results. One gives me a COGS of $13,751. The other one gives me a COGS of $12,472. Relatedly, their perpetual amounts are also more COGS with Lifo than FIFO. Now, the reason why that happened is Lifo assumes that we sold our most recent purchases first. And during a time of rising prices, which generally prices are rising over time, Lifo is going to supply higher cost of goods sold and lower ending inventory amounts. It's going to assume you sold the most recent purchases at a higher, that cost the firm more, and so that amount of cost goes into cost of goods sold. It assumes that you didn't sell your oldest purchases, and so those oldest purchases, their value goes to the ending inventory on the balance sheet. Average weighted cost, obviously, is going to come somewhere between the two because Lifo and FIFO are opposite ends of the spectrum. Average is sort of a middle ground. So we're going to talk about the advantages and disadvantages of FIFO and Lifo. And, like I said, average weighted cost kind of just comes in the middle of all this, so it weighs the advantages and disadvantages of both methods equally, or not equally, but somewhat. So FIFO, what's an advantage? It typically corresponds to the physical flow of goods. This is not a theoretic advantage because it doesn't matter in theory what we assume happens, but it could help you practically in terms of setting up the flow and the record keeping, the records of your inventory system. Inventory on the balance sheet is closest to current cost. So if you think about where things are put, right? If you think about this purchase log and you look at what goes where, right? Under FIFO, I sold this old stuff, but my most current prices are my ending inventory. Under Lifo, the opposite. So inventory costs on the balance sheet get closest to current costs because FIFO assumes that those most recent purchase price are still in the warehouse, therefore they end up in your inventory balance. Cost of goods sold tends to be lower and net income higher in times of rising prices, like I said, because you're assuming you sold old stuff at relatively lower prices. That goes into the sold, which is your cost of goods sold. Therefore, under FIFO, cost of goods sold is less. The disadvantages are just kind of a flip of the advantages. COGS is not going to be current cost. COGS is going to be older prices. So we're putting old prices against current sales, which is kind of an issue about matching the most current recent purchase prices to our current recent sales prices. In times of rising prices, COGS is going to be lower, which will increase my tax expense. Increasing the tax expense makes me pay more taxes, and that is disadvantageous because I'd rather lower my tax bill than to show high accrual earnings. Because the ending inventory is going to be priced at the higher, more recent price points typically, there's also a greater chance that you may have to write down the value of your inventory per the lower of cost or market. We're going to look at that in the next module. The advantages of Lifo are somewhat, to some degree, the disadvantages of FIFO, right? We get to match current costs with current revenue. The most recent prices are going to be put into my COGS account. It is tax advantaged in a time of rising prices. It increases COGS, which lowers my tax expense. I have to pay fewer taxes, which is good news for firms. A smaller chance of write-downs. An advantage of Lifo is it reduces inventory profits, which is that under FIFO, I'm matching old prices against current sales. Current sales prices are going to be higher, and that's going to induce more gross profit. When I use FIFO, it's going to have a higher COGS. That higher COGS is actually a sort of illusion. It's an inventory profit. Right? If I assume LIFO, my costs are more in line with current costs, which means that there is no inventory profit. A disadvantage of LIFO are some of the, again, the flip side of what we just talked about: lower priced inventory balances, lower net income. We're going to get into this a lot in the next module: potential liquidation of LIFO layers. The LIFO layers are going to be those old layers that could stack up if I don't sell through all my inventory in any one given time, right? Because it always puts my oldest stuff in ending inventory. Therefore, if I don't sell through all that ending inventory, I have old price points from who knows when. Again, think back to the dog example, the dog food. If that dog food is sitting at the bottom of the bin for months and months, right, that would be an issue. I'm creating old layers of food, but so then when I run out of food, I didn't buy any, I don't, purchase enough, I have to dip into all that stale food. It liquidates those old layers, and it results in high and lower cost of goods sold, higher net income, which is the opposite of the rationale for wanting to actually use LIFO. There's a greater possibility for income manipulation because you can time purchases now to liquidate old layers to increase your cost of goods sold. For example, I could not purchase these two, and then I would end up selling through my $8 inventory, which would release a higher cost of goods sold. A lower cost of goods sold than if I went ahead and purchased new inventory at 9 and 10. That would reduce my cost of goods sold. It's easier to do that under LIFO, obviously. And then finally, using a LIFO system is troublesome to project inventory costs, because if you're trying to project inventory costs at the end of the year, you're only at January. You have to have, then estimates of what the price points are going to be doing toward the end of the year, all that stuff. And so it's a little bit more troublesome to deal with from an internal standpoint. Right? We'll talk more about those in class. We'll also work through an example in class that I will work up and print out and post online. We will also work through the two examples that we have here in class with as much time as we have.